And let's focus in a little on what you were talking about, where we're trying to come up with that thoughtful process, build that thoughtful portfolio. You have to kind of choose what your certainties and uncertainties are. So, for example, as of this recording, the 10-year treasury is about 3.8%, the yield. You would, even if you bought that certain return over the next 10 years, there would be some inflation uncertainty. And so maybe I ought to say we go and buy a 10-year treasury inflation protected security, and that yield is maybe like 1.7, 1.8. So you could guarantee after inflation, your money's growing at 1.7 and 1.8% each and every year. And you've eliminated generally all uncertainties, but you couldn't really grow your wealth at a rate that would allow you to either live your life, do anything other than save, or ever have any sort of chance to retire. So if we know that we need to add some uncertainties to the portfolio, how do you start going through thinking of those different trade-offs, those different expected returns, et cetera?
I remember talking to my mom before I posted this blog post about that topic, about once you buy risk-free investments like treasuries, and then you buy real treasuries, which means you adjust for inflation, so you're not inflation risk, right? And the 1.7% you described, that's if you protect against risk and then protect against inflation, that's when you can guarantee yourself. And it's just not enough to grow someone's wealth. 99.9% plus the people in the world, they're not going to live the life they want to live if they grow at 1.7% guaranteed. So to your point, we have to take risks. But I remember calling my mom and be like, this blog post is going to go wild. I called it the Jimmy Buffett Portfolio, because you have no worries anymore. You managed risk, you manage inflation, you are toes in the sand, Corona in your hand, Jimmy Buffett lifestyle. And it was not a very well read blog post of mine. But I thought the idea of people are going to start calling it the Jimmy Buffett Portfolio. Just go buy all real treasuries. But thank you for...
Well, maybe this is what's going to allow it to catch on now. We're going to have a second coming here. Sort of like something that doesn't do well in the movie theaters, but crushes once it goes into people's homes.
Now people will know when I submit for conference presentations about the Jimmy Buffett Portfolio. Now they'll maybe let me in. So agree with you. Our firm, we think about it this way, which is there's three asset classes we primarily care about: global stocks, normal sort of nominal intermediate term bonds. That's just kind of what somebody thinks of as a normal bond. And then ultra short-term bonds, which is very similar to cash. And the reason why we think about those three is because if we start with the last one, so ultra short-term, and we'll use treasuries here for a second. So ultra short-term treasury, that'd be like a 3-month treasury bill. It's risk-free and it's going to mature really quickly. So if you say you can get a 6% yield in a short-term treasury and it's a 3-month treasury, I know that 3 months is 1/4 out of the year. So I'll get 1/4 of 6%, or I'll get 1.5%. I have a very, very high clarity, basically the utmost clarity of getting 1.5% over the next 3 months. That's super helpful for planning if you can provide certainty, right? When you put in an input into someone's financial plan, or you're just describing how much certainty or uncertainty you're willing to accept, someone being like, I basically guarantee myself 1.5% over the next 3 months, as Peter, you described earlier, maybe there's some inflation risk there, but for the most part, that's a really, really robust input with very little uncertainty around it. That's helpful for planning. Then there's bonds, and bonds, which have the same structure as a short-term treasury, that could be very similar as far as it's a debt security. You're loaning your money out to someone, you'll get a stated yield, and it'll say you can buy, as you described, a 3.8% yielding 10-year bond. That means your expectation is I'm basically going to get around that for the next 10 years. To your point, you don't quite know what will happen with inflation. It's definitely a little bit more complex than you and I are sort of talking about through here, but that's the idea. Now, in the ultra short-term treasuries, your real is going to match your expectation. I don't expect any surprises around that. When you buy a 10-year treasury, all of a sudden, you sign up for being a little bit surprised through time. Now, if you can hold on for all 10 years, you should expect to get your yield or something close to it. However, just look back to 2022. 2022, we had this spike in inflation, and intermediate term bonds had a terrible year, I think down about 15% at one point. So you don't expect to say, oh yeah, you'll get about 4% every year, and then have your advisor say, oh, by the way, this year we were down 15%. That's a really harsh outcome, or a frustrating outcome for someone that wasn't aware that could happen. And so bonds are different than ultra short-term treasuries. As you said earlier, the longer you hold them, the more reliable your outcomes, but you can have quick shocks to the system based on factors like a shock in inflation or something. So bonds really have to be tied to someone's investment horizon. And then even more so are stocks, because with stocks, you don't get a helpful yield. You can Google a stock yield and it'll tell you the dividend yield is XYZ or something. I know Taylor Schulte was on your show recently, and dividend yields aren't helpful. They don't tell you anything. That's just as your investment giving you some of your own money back. It's not like a bond where your return is on top of your investment. So what people should know is that stocks don't give you any helpful information about what to expect, except they have a long-term average. And what, as you described earlier, Peter, sort of like, that's what's going to inform how we should expect to do. We have about 100 years of data. Stocks tend to do between 8 and 10% per year. Certainly makes sense that, I believe you described the 10-year bond, risk-free bond at around 4%. I know even shorter-term bonds right now are about risk-free for 5%. If someone's going to convince me to buy stocks or anything else that has risk, I better expect more than 5%. Otherwise, I'll just go buy what's for free that would yield me more. So for stocks, you'd always expect them to be more than 5%. Turns out the long-term average is about 8 to 10%. That's reasonable. If I'm going to give my money away and buy sort of companies across the globe and own small pieces of them all over and not have any say in how they're run or anything, just sort of a passive owner of them, I could have a really bad outcome, right? We know periods, global financial crisis, the 3 weeks after COVID hit, you get really bad outcomes as a stock investor. You need to be rewarded for that. You'd expect to be rewarded above any risk-free rate. Turns out it's about 8 to 10% a year, but over a really long time horizon. So your initial question of sort of like certainty to uncertainty, expected returns, I would say you always want to take a snapshot of the risk-free returns. So the ultra short-term one, call it 3 months or 6 months. The 10-year treasury, what you can guarantee yourself, not including inflation, for 10 years. You're always going to buy stocks thinking you're going to get more than that, but that there's some variability around that. And also that you might be wrong. We can have decades where stocks don't do what we wanted them to do. They can't underperform treasuries for longer than 10 years. And so that's why our business is so fascinating, because it's like, hey, we can make all the best decisions, just like at a poker table, and we can do terribly. The longer time horizon you have, the higher probability you will achieve sort of a well-calibrated capital markets expectations, what you thought would happen. But as you know, investors are commonly frustrated, and that's because expectations don't have to match reality. It's why it helps to really understand the things that you own. So that's how we think about certainty to uncertainty. When you design someone's perfect life through their portfolio, you are taking this timeline of things they're trying to accomplish, whether it's college for the kids, weddings, homes, retirement homes, nursing homes, whatever it might be. Those are all inputs. And we have to basically connect the types of assets they own and the uncertainty embedded within those assets, or the expected uncertainty, I should say. And that's how you and I design portfolios.